Hello, my name's Carl Williamson. I'm the manager of the Nexus Global Solutions Portfolio and the Nexus Global Dynamic Portfolio. It's July 2023 and I'm speaking to you from our London offices. The Nexus Global Solutions Portfolio is up 0.8% in June, while the Nexus Global Dynamic Portfolio is up 2.6%. This took the respective returns for the year to 1.8% and 6.5%. The second quarter was more or less flat for a sterling investment and multi-asset portfolio. While it was a positive month for global equities, the strength of sterling paired those gains. UK equities underperformed and gilts had another bad quarter. The net result for the portfolios was that the Nexus Solutions portfolio was up 0.2% in the quarter, while the Nexus Global Dynamic portfolio was up 3.5%. UK bond yields moved higher and gilt prices lower as inflation in the UK proved stickier than hoped. The Bank of England raised interest rates to 5%, the highest level seen since 2008. Central banks continue to fret about inflation, with the terminal rate increasing for both the ECB, the Federal Reserve and the Bank of England. Futures markets are now pricing higher terminal rates for all three than had been predicted at the end of March. Economic data on the whole continues to be better than hoped. Weakness in the manufacturing sector is being more than offset by strength in the service sector. There are some early warning signals in terms of the forward-looking business surveys, and in the Eurozone we have entered a technical recession. Despite this, a robust employment situation continues to support the consumer. Although UK headline inflation have moved back to single digits, concerns remain. In an effort to curb inflation, the Bank of England put up interest rates by 0.5% to 5%, having previously had 2 periods of 0.25% increases. This put pressure on the front end of the yield curve, with 2-year bond yields moving to 5.3%, having been closer to 3.5% 3 months ago. In the Solutions portfolio, we did take advantage of this increase in short yields, buying short-dated bonds that were yielding between 4.5% and 5%. A trio of factors in the US has combined to mean that the US stocks have outperformed other regions during the period. Firstly, economic data remains relatively robust and inflation is coming down more quickly. Related, the Federal Reserve is closer to the end of its tightening cycle. Finally, and most impactful for financial markets, there is much excitement around stocks related to artificial intelligence. Investors have been flocking to those companies that they believe will most benefit from this transformative technology. We recognise the clear potential that AI brings, and we have a number of stocks in the portfolio that we clearly think would benefit, including stocks like AMD and ASML. However, we are wary of chasing the latest hot theme, and so remain focused on quality stocks trading at reasonable valuations. There is always the risk that consumers will be squeezed out of existence before the central banks stop putting up interest rates. However, equity valuations remain fair and investors will continue to look towards the medium and long term. For those investors in multi-asset portfolios, bonds now provide a viable alternative. It's been my pleasure to speak to you. I look forward to speaking to you next month.